I'm Jyoti from MyTime Equity, and we are happy to have you with us today. Joining us today are Sudhir Pai and Anup Nayak from MyTime Equity. Before we begin, I would like to take this opportunity to introduce you to Sudhir Pai and MyTime Equity. As an actively managed portfolio management and RIA firm, MyTime Equity takes pride in being your dedicated partner on this financial journey, helping you to plan, grow, and preserve your wealth with confidence. Sudhir Pai is a founding principal of the firm and serves as a fiduciary investment advisor representative, bringing deep expertise in wealth management and tax efficient investing. Before I hand over to Sudhir, let me take you through the disclosure slide, which our attorney's mandate we show prior to every webinar. Kindly request you to scan the QR code to join our MyTime Equity WhatsApp community to get exclusive updates on everyday market update, alternative investments, real estate, crypto, ventures, and many more. If you have any questions during the webinar, please type them in the Q&A box, and we will be happy to address them during the Q&A session. If you like to connect with Sudhir after the session, you can reach us at wealth@mytimeequity.com or call us at 972-330-2771. Over to you, Sudhir.
Thank you, Jyoti. Very good morning, folks. Hope you guys had a good Halloween night yesterday. So we are here today talking about the equity markets from last week, as well as what is that we are seeing for the future from here to end of the year. So the market was positive. S&P 500 and Nasdaq both gained about 1% and 1.9% respectively. Bitcoin and gold both fell, so metals took a little bit of beating. Bitcoin was down by about 4.4% and gold was down by about 2.4%. Next slide, Jyoti. Jyoti, you need to move to the next slide. Anup, are you there?
Yeah, I'm here. Let me just try to coordinate 1 minute.
Sorry, guys.
Yeah.
Okay. So and silver was flat. Silver for some reason did not follow gold, which is what happens typically, but silver was up 2 days and down 1 day, so it was kind of flat. Government shutdown is continuing to go on, and the poly market and the clashy markets, which are the betting market, shows that this may go on for another 6 to 7 days. So November 7th is when the surveys as well as the betting markets show that the government shutdown may end. But currently it is almost 30 days and government is still shut down, and it has started to impact some of the day-to-day operations of this economy. And a lot of data which usually comes from the government departments, they are not coming out, and because of which information from companies like ADP and other private companies are being used by the markets and by the experts today to get an idea as to how the economy is progressing. We had the FOMC meeting last week, and Fed cut the interest rate by about 25 basis points. The not so good thing was about Fed Chair Powell being a little hawkish, wherein he said that the next cut is not guaranteed and nothing is confirmed, and they will go based on their data as well as their understanding of the economy next month in December, and take the decision on the next rate cut of 25 basis points. That was not very comforting to the markets, and immediately we saw some corrective action. Small caps took a beating, and some of the non-tech large cap also took beating on that day. Bank of Japan and European Central Bank, they also followed suit, and the note from Fed Chair Powell was not so interesting. and we need to see what is the impact of that in the coming months, because earnings have been on, and close to 61% of the S&P 500 companies have reported, and of which 84% of them are beating expectations, which is a solid number by about 5%. More results are coming out next 30 days, and that will lay out the course for the next quarter. So in my personal opinion, we are going to see a good year-end rally. We may see some sideways movement and little bit of choppiness in the next 2 weeks. I think between now and November 18th, we may see anywhere between 5 to 7% corrective pullback, which is actually good for those who are sitting on the sidelines who want to put their money back in the equity markets and ride the upside wave, for the next 2 months. So my personal estimate for the S&P 500 is anywhere between 7,000 to 7,300 points, which is pretty aggressive. And we believe that we will see a rally in Bitcoin, gold, as well as stocks. One of the main reasons for that is because most of the institutions which have been taking a bearish stance have been sitting on the sidelines, and they really need to put their money in the equity markets, because usually the last 2 months of the year, particularly in a year which has done about 15% return so far, 95% of the times, the last 2 months does really well. And also, the 401k money has to be pumped. Most of the employees who have not yet decided how much money to put in 401k decide to put most of their paycheck for November and December in equities. The contributions to defined benefit plans and other IRAs, SEP IRAs, all of that happens in the next 45 days. And that's where there is going to be a lot more money coming in the equity markets. But I think all of that will happen after a short, small correction, which may be in the range of 5 to 7%. And we suggest buying the dips when that happens. Next slide, please. Okay, so the subject of today's webinar is why playing safe is the new risk. So as I said, next 2 months, it doesn't make any sense to play safe, because the markets seasonally, as well as if you look at all the other data of the current earnings, as well as the ratios, as you can see here, the ratio between high beta stocks and low volatility stocks have both been at all-time highs. Which means most of the money is going into growth stocks and high beta stocks, and not in safe and defensive ones. If you look at healthcare, if you look at staples, all of these defensive ETFs have not been doing well. Whereas if you look at technology, if you look at anything related to high beta, it has been doing very well. So both these indicators give us a strong feeling that the next 60 days is going to be really good. So sitting on the sidelines with cash, or trying to be defensive by putting money in staples or treasury bonds, is not a good idea, at least for the next 60 days. So it is something that one has to keep in mind. So the right leadership as of today is growth, and it's only growth. So you need to put money in growth stocks, growth ETFs, growth related products, offerings, so that your money can grow, beating the inflation that we have right now. Inflation right now is around 3.5%, but this number is on the reports that comes out of the government departments. But we all know underneath, the inflation numbers are much higher than 3.5, because every day when you go to restaurants, when you pay Uber or you pay any of the essential services, the costs are all going up and have gone up significantly over the last 3 years. So that means inflation is high. So sitting with money in the bank account earning 3% is the biggest mistake you can make. So this is the time to invest in growth and make your money grow faster than inflation. So please keep this in mind, guys. So playing safe is the biggest risk at the current time. So courage over comfort. Next slide, please. Okay, so we are seeing a rotation, in the market. As you can see, with the interest rate cut happen at 25 basis points and more cuts likely to come in the next 12 months, 55% of the stocks are trading above their 200-day moving average, which means 45% of the stocks are not, which means that rotation is happening from growth to even the other stocks. So 55% of the stocks going above 200-day moving average. If you look at 200 days, 200 days is nothing but 1 year. So if all the stocks are more than what price they were trading at 1 year back, that's a good sign. And more of these stocks are going towards that number, which means the other 45% is also going to touch that 200-day number, and then the markets overall will perform, and we are going to see a lot more green days than red days. And if you look at the small cap index, which is the Russell 2000, and the broad market index, which is the Russell 3000, they both have touched new all-time highs, but still they are much below the S&P 500. So that means there is a lot more room to grow, and we see that happening in the next 60 days. Consumer discretionary versus consumer staples. Consumer discretionary is has reached all-time highs, and consumer staples, which is the most defensive sector, that has not been doing well, because there is no point in being defensive at this point of time. So the money is flowing into other growth areas, in other companies other than just technology. So broadening of the market is happening. It doesn't mean that the growth stocks or the technology stocks will not do well. So everything will continue to do well, because in the next 60 days there is a lot of money that will flow to the equity markets for two reasons. One, when the interest rate cut happens, money will get out of the bank account and go in equity markets, because what money you make in your checking account and money market account is not good enough. If you're making 3.5%, that's useless. So it is better you put it in growth stocks or stocks in equities, and that is what is going to happen. And lot more money is going to come from global markets to the US, as most of you might have seen. Indian government is letting Zerodha invest in US securities. So Indians living in India can invest in US stocks through the GIFT City, which is created in Gujarat. So that bill is also getting approved, and Zerodha is launching that platform, to Indians living in India. So that means a lot more money is going to flow in the US equities. So that means US equities can only do well from now on. So don't worry about the all-time high, because when inflation is high, markets have to do well, because nobody wants to keep money in the equity markets, in checking accounts. So if you are one of them who is keeping money in the checking account or in treasuries, that's the biggest mistake you are making right now. I'm repeating this again, because you need to come out, you need to put money in the equity markets. And we have a lot of ideas which we'll talk about, where there is a principal protection, FDIC protection, and all that. So, but it's important to put money in growth, not in staples or defensive stocks or in treasuries. So very important point, guys. And you will get an opportunity in the next 15 days. I think there will be a dip of anywhere between 3 to 7%. So that dip is a buying opportunity. So don't let that go, because if you let that go, I think it's gone. Till we see a much bigger correction happening. In my prediction is that it may happen sometime in 2026, where we will see another big sell-off like the Liberation Day. But since we do look at the markets every day and every week, we do these webinars, so you need to take one day at a time, and then make your money grow. It's very important that one is active with their portfolio. Next slide, please. Okay, so this is what I was talking about. If you look at the data from 1950 to 2024, huge range. When a particular year has done 15% by end of October, you will be seeing an average return of 2.7% in November and 2% in December, which means seasonally and historically, November and December have done about 4.7%. If the returns year to date by end of October has generated more than 15%, which means the probability of your money making close to 5% is very high. And as I said, a lot of money will flow in the markets from all over the world, and we may see huge strength in November and December by end of the year. So don't blame me if you invest today and if the market goes down day after tomorrow, because markets going up and down is normal. but you'll have to see what will happen as of December 31st. So for the end of the year rally, we have to go all the way up to January 15th. It's called as the Santa Claus rally, which happens in December and ends in January. And February is a seasonally weak month because most of the companies will be reporting their earnings for Q4 of 2025 in January and February of 2026. So that's when most of the numbers will not be looking great, because all the window dressing happens at that time, because all the CEOs want to get their performance bonuses. So all of that is based on 2023 on the Q3 numbers, because the year-end stock options is what is given to them. So that stock option is really given to them, and then in February, for that stock option to be given, they want a lower price. So usually in February there is sell-off. So February is typically a down month, but between now and the end of December or mid of January are good weeks, good months. So good time to be in the market, staying long and making that extra money that you can make. Could be anywhere up to 4.7 to 5% if you look at the seasonal numbers that one can make when historically year-to-date numbers as of end of December has exceeded 15%, and this year is one such year. So we are comparing this year to all those years from 1950 to 2024, and looking at the probability of generating between 4.5 to 5% for the next two months. Next slide, please. Okay, on the macro standpoint, we are getting a lot of information, but it all depends on which government department is working, which department is working 50%, like SEC is working 50%. They said the government department, the labor department said that some of their employees are coming to work and they will be releasing some of the information next week. So we are going to see PMI numbers, which is the manufacturing index for manufacturing, for services, and then the jobs opening, and then the ADP report. So there is information coming out next week. So volatility will be high, plus all the earnings that are coming out. So all of this put together, markets will be going up and down. In the morning, if you see green, by evening you may see red. So that's called volatility. So you will see huge amount of volatility in the next 2 weeks, and that is where I believe that the S&P, which has gone up so high and touched the resistance point, is going to see that mild correction of anywhere between 5 and 7%. And that's the opportunity for us to get in. And sooner it happens, better it is, because we don't want that to be dragged all the way to the end of the year, because those who are expecting to make money may end up not making money if you wait till December 31st. So buy the dip, do dollar cost averaging, and if you are coming to us, that's what we will do. We'll put the money slowly and steadily in the market, so that in the long term we will achieve good returns on your money. Next slide. So our portfolios were not that great. Our portfolios took a little bit of lack of performance compared to the broader market, the S&P 500. And primary reason for that is because of gold and Bitcoin. We have gold and Bitcoin in all our portfolios. But if you look at our solo portfolios, the growth model did very well compared to S&P 500. And all other models for the week were down, while S&P 500 was up because of few companies like Microsoft and Google. They did very well in their numbers, and Tesla and Roku and few other smaller companies like Roku and MongoDB, these did very well. So if you look at our individual stock model, they outperformed the market like crazy. If you look at the high beta model, we were up 2.6%, whereas S&P was up 0.7%, and all weather model was up almost 2%. So our individual stock model did very well. This clearly shows you that only few stocks performed in the bank of about 500 stocks, and metals took a beating, crypto took a beating. So overall, we saw a lot of sideways movement, which is good. Usually gold, metals correcting means it is the trend setter, which means we should see the equity markets also consolidate a little bit next 2 weeks, and then giving us an opportunity to rally or put new money in for the year end. So nothing alarming. Everything is going as per plan. I have been telling that we should be getting a 3 to 7% correction from last 2 weeks, and we are seeing that correction happen in some sectors of S&P 500. S&P 500 is a 500 company ETF, and because of that, it kind of is pretty stable when you look at it. Whereas our goal is to generate a much higher return than S&P 500. So when you're trying to aim for that, there will be few weeks of not doing well versus the S&P 500. Not every week we can continue to do well, because if we do well every week, then then S&P is going to replace our index to theirs, right? So that's the point. So S&P 500 is very stable, simple 500 companies. When it falls, it falls. When it goes up, it goes up. But ours is a diversified portfolio. We have international companies. We have metals and crypto. In crypto we have Bitcoin and Ethereum. So all of that is not part of S&P 500, whereas ours is quite diversified. And if you look at the ETF models on the left-hand side, the international model has done almost 23%, which is far better than what US 500 companies have done. If you look at metals and crypto, we are about 35%, whereas S&P 500 is 17% for the year. So overall, we are doing well, but last week was not such a great week for us. But I'm sure the next 8 weeks we will do extremely well versus the broader market. Next slide, please. Okay, quick glimpse at some of the private equity funds. We talked about public markets, but there are some extremely good private equity opportunities. These are funds, and these are all large funds. If you can see the size of the funds, AUM stands for assets under management. If you look at these funds, they are anywhere between 300 to $3 billion size. So we wanted to show you these 4 funds, which are extremely good funds and large funds. These funds have not lost money, capital, at least for many years in the past. And these funds that I'm showing you here, they are big in artificial intelligence, software, education, healthcare, technology. And the 2 funds that are in the center, the Kohler and the Carlyle Alp Invest Private Market Fund, they buy alternative investments from large endowments and like Yale and Harvard and all of these, because there is a lot of pressure on these large endowments and family offices to exit some of their positions, so they can take that money and invest it in equity markets, or put that money in their core business like charity and things like that. So these 4 opportunities here range all the way from AI to cybersecurity. If you look at Stepstone, the last one on the slide, they have about 18% investment in SpaceX, XAI, and Anduril as well. So these 4 investments are great investments. The minimum to invest in each one of these is $25,000, and these are evergreen funds, meaning if you want to exit out of it anytime, all you need to do is apply for a redemption, and they will redeem up to 5% of the fund. So 5% of the fund is a large amount. Like, let's say $2.6 billion fund, 5% of that is close to $10 million. So up to $10 million they will redeem every month. So not everybody who invests asks for redemption every quarter. So for every quarter there is a redemption of around 5%. So if you want to diversify your money so that you are not at the all-time high public market, and if you want to diversify it into private funds which are non-correlated to the stock market, right? Because these are not available for buying and selling like every 5 seconds. So these are not marketable securities on the equity markets, right? There is no stock market for this. A redemption has to be done on paper, and you'll have to ask us to help you with it, and we can redeem. So these are non-correlated, non-volatile, but extremely good companies. And these are the funds where you can invest in healthcare, like EQT. They have invested in 3 best companies in India in the healthcare space. And the return of this particular fund from July to September is around 11.5%. So pretty good returns for a few months there. And then if you look at Kohler, which is in secondary deals, they buy investments from companies like TPG, Blackstone, Carlyle. They buy funds from secondary market and in technology, healthcare, and consumer sectors, and their return has been about 13%. Carlyle, the Alp Invest Fund, also has generated about 12%, and the Stepstone Venture and Growth Fund, which has a lot of pre-IPO names, has done about 15.4% for the year. So if you look at this, these are good returns, not going up and down like crazy, and this will give some amount of cushion to your portfolio, right? Because there is no volatility here. You need some things where money is not just going up and down every day and you get worried looking at it, like the public markets. So these are some options. If you are interested, write to us at wealth@mytimeequity.com, and happy to put you in these funds. These funds open up every month in 4 days or 5 days in a month, and you can exit out of them once in 3 months. So write to us if you are interested, guys. Next slide, please. Okay, structured note. So we created this structured note with Netflix in him because Netflix went through a little bit of correction because of some Brazilian tax issue. So we got 2 notes created, one from Goldman Sachs and the second one is from Morgan Stanley. Both the notes are trading on November 12th. The first note has Broadcom and AMD. The second note has Robinhood and Oracle. Given that, we are expecting the market to go a little sideways or maybe 5 to 7% downwards, we think, we will be able to capture the lower price, by November 12th. At least that's the expectation. Nobody can exactly time the market, but that's what we are trying to do here to an extent with the 50% barrier. So 50% barrier is a good barrier for a 3-year fund, 3-year note. And the way this works is if all of these 3 stocks are flat or positive at the end of year 1, in the first case, you make 70% return. In the second case, you make 125% return. These are solid numbers. And for any reason of all the 3 stocks are not flat or positive on November 13th, 2026, then it goes to end of year 3. And at the end of year 3, you get 4.4x of the lowest performing stock in the first option and 3x in the second option. So excellent notes. We got it done just for our clients. This is a custom note. The minimum to invest in this is $25,000. So if you're interested, please write to us and we can place a trade for you on November 12th. Next slide, please. And by the way, Netflix also came up with the news that they are going to split their shares 10:1. So that's another good thing. The price of Netflix should drive up in the coming many years. So, a good time to invest in this note, guys, Netflix note. Now, coming to the income note, a lot of our clients continue to be interested in income, while I am not a great fan of income note because I prefer a yearly income like the previous one instead of getting a monthly income. But for those who want monthly income, this is a 18% per year income, and it gets paid monthly, and then it has the memory feature, and the trade date for this is 14th November. And the underlying tickers here are Palantir, Tesla, and NVIDIA. And we have added one more feature in this, which is called 1 star. So 1 star means if any one of these stocks are positive at the end of year 3, at maturity, then you get all your money back. So there is 100% principal protection as long as one of the stock is positive versus 14 November 2025 price. So because of these 2 features, we are getting a return of 18%, which is not bad at all versus 3% that you get in treasuries. So this can be invested through your IRAs, 401ks, or any of kids account, corporate account. So this has enough protection, memory, and 18%, which is pretty good for multiple features that are included in this note. And this is from Morgan Stanley, guys. So please let us know if you're interested in this. Next slide. So the third note is a principal protected note. This is with the, we have 2 companies here, 2 notes. One is Palantir, Micron, and Dell, and the next one is Broadcom, Tesla, and CrowdStrike. So in both the notes, we have a return of about 40 to 43% in 2 years, and a return of 1.25x at maturity. Again, this is a principal protected note. So for a principal protected note, if you're getting this kind of a return, which is significantly higher than S&P 500's return, and 26, if we are seeing it to be a correction year because of job losses and because of market having to take a little bit of corrective action, because last 3 years has been very, very good for the markets with 20+% return. So if that corrective action takes place, and then this kind of principal protection really helps you. And at the end of 2 years, if it is flat or positive, all the 3 stocks, then you are making 43%, which is pretty good, which is like 21.5% per year. Or if it goes to end of year 5, then you are making 1.25 times, of the lowest performing stock of the 3. So you have principal protection, you have good returns at the end of year 2, then you have a good return at the end of year 5. So there is a lot of risk mitigation in place, and the trade date for this is November 7th, 2025. So if you're interested, tell us quickly so we can place trades for them on that particular day. So this is done through Charles Schwab account. Money should be there in the account by 4 p.m. on that day. Only if money is there and we have the authority to place the trade in your Schwab account, that is when we can buy it. Otherwise, you miss that opportunity. Next slide, please. Okay, so I think we are here at the end. Please do scan the WhatsApp group QR code and join our WhatsApp group, because all of these good stuff, the structured notes, the private equity, the tax reduction vehicles that we have. Our MTI fund is getting a lot of attention. The farmland project in Florida is getting a lot of attention, guys. So you can lower your income by almost 50% and pay tax only on the remainder of the 50%. So if you're interested in lowering your tax or growing your wealth through any of these ideas, please reach out to us and we'll be more than happy to help. I think Anup, now we can take questions.
Yeah, thanks. Thanks, Sudhir, for the insight into the markets and the offerings. One of the questions that is coming up is since there is a correction expected in 2026, what would be the fate of the Netflix structured notes? So I think that is what the question is.
That's a great question, and we usually do a 3-year note, not just 1-year note. And us expecting a correction in 2026 is based on the cycles that we research. But if you look at the macros, if you look at the earnings, doesn't look like we will have any kind of correction till 2027. So there is a little bit of conflict between the cycles as well as what we are seeing on a day-to-day basis under Trump's administration. And Trump is going to continue in White House till 2028. So usually when we see Republicans, in power, and particularly the way they are working right now on a day-to-day basis, 24/7, when it doesn't look like we will see a huge correction, but it can be a correction like what we saw during Liberation Day, which was a quick 20% correction and then back V-shaped within 2 weeks. So now our structured notes, we created for multiple years, not just for 1 year or few months. So, and we have breakpoints, right? We at the end of year 1, if it is flat or positive. So it doesn't have to be higher than what today's price is, right? Every quarter when the results come out, the market pumps. That particular stock does well, right? Only when the stock does not do well, like we saw Meta not doing well in terms of the stock price. The company came out with great numbers, but the stock got punished and it was down almost 13% Thursday and Friday. So stocks can get punished, but then quarter on quarter, the stock that gets punished this quarter will come back up next quarter. So this is a very normal pattern for companies in the equity markets. And also the traders usually, they have a certain pattern based on technical readings, when they don't want to invest further in a particular company. So there are a lot of factors going in a particular stock. Now coming to Netflix, we saw a corrective action in Netflix over last 2 weeks. Then we saw the split information coming on Friday. And then we are doing a 3-year note with 2 other tickers, and we have 50% downside protection. So any particular stock going down 50%, if we are protected, I think we are pretty good, right? So I think we have to invest. We can't keep money in cash. We can't invest money in illiquid investment sometimes, because real estate has not been doing well from the last 3 years. Interest rate is still unknown whether the Fed is going to lower interest rate so quickly, or it is going to only happen after the retirement of Fed Chair Jerome Powell. We don't know all that, right? So nothing is totally clear. While we can have certain probability theories based on past performances, seasonalities, historic numbers, we can only create structures which has a lot of risk mitigations in place, and then launch it, invest in it, and pray to God that we do well. That's all we can do, right? Otherwise, it's very hard to make money from investments.
Yeah, thanks, Sudhir. I think the most important point is that we were able to negotiate with both Goldman Sachs and Morgan Stanley for 50% barrier. I think that is a key that I would consider. And also,
Good point.
four growth notes that we have today, 2 of them have got 50%, 2 of them got 100% protection. I think we can't offer better than this, right? Or probably nobody can offer. So,
of course. And also, Anup, you bring a great point. Just see, if you look at our own negotiation process, how many banks did we go to, and who agreed to finally do the notes for Netflix, right? It was Goldman Sachs. So Goldman Sachs is very positive about the market. If you Google for the CEO of Goldman Sachs interview last week, he's super positive about the market. He doesn't think till 2027 they are going to see a corrective action, because the whole tariff thing and all, if it pans out the way they have come up with that strategy with some plan in mind, right? So if it all pans out, they believe that market is going to really go up continuously. This bull market is going to continue till end of 2028 or something. But the cycles show that the 43, because if you think that the bull market is on from 43 years, then the cycle may work. But if you think the bull market is only from 2025 Liberation Day, because there are two schools of thought. One says that the bull market started on the Liberation Day, restarted, and the other theory says the bull market has been on from 43 years. So these are all good scientific analysis called cycle theory, but nobody can 100% predict what's going to happen in the market. If somebody says that they know what is going to happen, then you should run away from them. All we can do is come up with some probabilities here, and then be careful. That's it.
Thank you. Probably I'll take the next question. So can we contribute into the evergreen private equity funds from IRA and Roth IRA? Yes, we have been reminding our clients that your old traditional IRA, Roth IRA, SEP IRA, old 401k, these are all the candidates that not only in private equity, but we can also contribute those funds into structured notes, infrastructure funds, private equity, private credit. And also, I just wanted to remind slightly differently that we also have a principal protected option called as fixed indexed annuity, which at present, it gives a bonus of almost up to 20%, but that is certainly likely to go down with the Fed rates coming down. So we have so many options that we can think not only from your individual brokerage account, but also from this traditional IRA. Do reach out to us, and then we can help. So if you want to please add, please do so.
Yeah. No, that's a very good point, Anup. And also, for those who don't know that we do life insurances, annuities, that's FYI for you. And today the most important focus for us is tax reduction, right? If you go to our website, mytimeequitype.com, you can see all our funds listed in one place. Our My Time Equity tax efficient income and growth fund is doing very well. So you get a 2.2 times write-off from your 2025 income, and then returns over a period of time in the form of income and then growth. And we expect this fund to be a 5 to 6 year fund. We would like to keep it short because our plan is to open one fund every year. So this is the 2025 fund. We are not raising more than $5 million in this fund, so we have a cap of 5. So we are close to about 1.2 right now. And I think we have a lot of demand. So if there is any interest in lowering your taxes for 2025, whether it is regular income, W2 income, business income, capital gains, or any type of income, have a conversation with us. We can certainly help you lower it. Tax planning makes sense for those who are paying taxes of 22% or more, right? If it is less than 20%, I suggest you look at only investments, because lowering taxes may not be a good idea, so that your tax return look healthy for taking loans and things like that. And I am very positive about real estate markets coming back sometime next year. So which means your tax returns have to be healthy so you can get more loans. and you can buy more properties, as you go. So guys, thanks a lot for joining today's webinar. Please reach out to us and take advantage of the next 60 days of busiest time of the year, and do plan for tax reduction, retirement planning, and estate planning. And let's close the year 2025 on a great note. With that said, thank you very much, Anup. Thank you, Jyoti, and look forward to speaking to you next week. Thanks, guys.
Thank you.